In this lecture, we're going to discuss how private equity firms manage risk and return. Specifically, we're going to focus on venture capital, and the example I will give you will be with an early stage venture capital firm. Before we dive into the details, I want to share two things with you. Two things that every investor is keenly aware of. Number one, that every business, no matter what the stage, has some killer assumptions. And they have at least one of those killer assumptions. And some businesses have multiple ones. What's a killer assumption? That means if that assumption does not come true, your business is not going to succeed. So one of the important things to assess is what is the killer assumption and what is its impact and how can you control it? How can you take that assumption and turn it into a fact? The other thing I want to bring up is that there's something that I call the assumptions versus fact ratio. In most businesses, particularly early and seed stage businesses, the assumptions to facts ratio approaches infinity, meaning that the number of facts are very, very few, if not zero. So there's a lot of assumptions in early stage businesses. That's what makes them very risky. So the killer assumption, which might be one assumption, that's fatal if the assumption is wrong, and the assumptions versus facts ratio. Those are two key things that investors try to analyze and look at before making any investment. This slide, we're going to address risk and sort of try to categorize risk and the amount of risk that exists based upon the various different stages of the company. So for example, in venture investing, you can roughly categorize companies into one of four stages. Some people will tell you there's 5 stages or 6 stages. That's really not the important point, but I just want to give you conceptually sort of the various different stages. So seed stage is a company that has no revenue, probably no product, probably has a business plan. It may have a laboratory prototype of a product or a very rough wireframe mock-up of some product or service. And when I use the word product, think of that can either be a physical product, like a widget or a device that you sell, or it could be a service, or it could be a software app. So those words are sort of interchangeable in most of the discussions we will be having. So a seed stage company, very early, few employees if any, probably nobody getting paid, and no product, no revenue. An early stage company would typically have a product, at least a beta level product, that maybe they've put in the hands of a few customers. They may have some revenue, not much revenue, from those beta level customers, or they might actually have a real product in the marketplace and they've generated $500,000 to maybe $1 million in revenue. Again, these are just some sort of guidelines and there's nothing real hard and fast about these various different stages and steps. A growth stage company, well, what that really means is that the company has sort of refined the product, it's in the marketplace, and they're really looking for capital in order to take that product and propagate it out into the marketplace. So they probably want to use capital to build a sales team, to build distribution, maybe to build the next generation of product, those types of things. And a late stage company is one where they have significant revenue and they really need some additional capital in order to build out the business. So for example, they may be wanting to build another factory or open up a distribution office someplace, or they might want to expand into foreign markets. So those are all various different phases of a company and the life that they go through. Again, the seed stage company is probably looking for capital in order to get their product developed or to finish their product development. The early stage company is probably looking also for maybe some money to finish their product development and to build a kind of small sales team. Now, that was the left-hand side of the slide. What's on the right-hand side of the side? Well, the right-hand side represents the number of companies that will return 0 to the investors. So for example, a seed stage company if a VC invested in it, 5 out of 10 of those companies would go out of business and the investor would get nothing back. So as an example, at Primary Ventures, which is the follow-on to High Peaks Ventures, where I was a co-founder, we see at Primary approximately 400 business plans a year, right? We invest in somewhere between 4 to 6 companies in a year. So that's a 1 to 1.2% is sort of our investment rate of the companies that we see. So when I'm talking about 5 out of 10 failing, it's really 5 out of 10 of that 1%. So it's already a pretty exclusive club that you're seeing, and at least some investor thought that that company could be a success and put some money on the table. So in the seed stage, you have to figure somewhere around 5 of the companies, 5 out of 10 companies are going to go out of business. Early stage, again, the company's a little bit more mature. You have a little more data on the company, its product, its management team. Probably 4 out of 10 of those will go out of business. When you think about growth stage, now you already have a product in the marketplace. You see that the product is getting traction. The company has some revenue, probably not enough revenue to maintain itself, because clearly if they did, they wouldn't be out raising capital. But it's a pretty good bet that that company is going to be around, and 2 out of 10 of those will go out of business. And once you get to late stage, where you really have an existing enterprise that's looking really to expand rapidly and in a big way, chances are only 1 out of 10 of those are going to go out of business. So why is all this important? Well, because it really impacts the way investors look at companies, and it impacts the amount of return that they need to think about in getting out of each company in order for the investment firm, the VC firm, to make a profit for its investors. So let's conceptually talk about a venture capital firm, and it has some money to invest. Let's say it's a seed stage venture capital firm, meaning that it sort of focuses on seed stage companies. Venture capital firms tend to sort of focus in 1 or 2 segments at most, except for the very large venture firms. Most of them do not invest across the spectrum of stages that we spoke about in the last slide. Most of them tend to migrate towards 1 or 2 of those sort of categories. So let's say you're a venture capital firm and you have $10 million to invest, and you invest in the seed stage sector. You find 10 companies that you like, and again, this takes time, but let's just assume you found 10 companies that you like, and you make a $1 million investment in each of those companies. So you started with $10 million. You now have invested $1 million in 10 separate companies, 10 separate seed stage companies. And so your $10 million is gone. It's all invested. And let's see what happens. Let's talk a little bit about what will happen theoretically with this $10 million that you've invested in 10 separate seed stage companies. Well, if you remember from a few slides ago, we said that 5 of them will go out of business, which means your $1 million in each of those 5 companies is gone. It's kaput. You've lost it. You haven't made any money. So if you look at sort of the column on the slide that says running total, that says I've invested in 10 companies. I have, so I'm $10 million in the hole. My money is gone. It's invested. And 5 of those companies, I've lost all of my money, right? So I have 5 companies left, and I'm $10 million in the hole, right? Not a great place to be, but that's reality for a seed stage investor. Out of 2 of those companies, I'll probably get back 1 times my money. So I invested $1 million, I'll get $1 million back. Now, you know, if you're a bank, that might be good, but for venture capital firms, that's not very good. So I'm still $8 million in the hole, right? So if you look at the running total, it says minus $8 million. Again, I've invested $10 million. 5 companies have gone out of business, 2 companies returned the amount of money that I invested. So somehow, either by the sale of the company or liquidation of the company, or in some manner, I got back my $1 million. So now I'm $8 million in the hole, right? And how many companies do I have left? Let's see, 5 plus 2 is 7, total of 10. So I have 3 companies left. Now, out of those 3 companies I have left, in 2 of them, I'll probably get back on the average 4 times the money that I invested. So that's not bad, right? If I get 4 times back on all my companies, that would be actually great. But out of 2 of them, I'll get back 4 times the money I invested. So that would be a total of $8 million. And so now I'm back at break even, right? I invested $10 million, $1 million each in 10 separate companies. I got $1 million each from 2 companies, and I got $4 million from 2 companies. So that's a total of $10 million. So I invested $10 million, I got $10 million back. So that means I have 1 company left, just 1 company left. And that 1 company is the difference between having a successful venture capital firm or a non-successful venture capital firm. So hopefully out of that 1 company, 1 of those 10 is going to return 10 times the amount of money I invested. In other words, for a $1 million investment, I'm getting $10 million back. So now my running total is plus $10 million. I invested 10, I got back a total of 20 million. So that's pretty good, right? So you would think, that's 2 times return for your investors. Not quite, because the way the venture capital business works is most venture capital firms take 20% of the profits, if you will, which this second $10 million is sort of a profit. So the investors really get $8 million back, and the partners in the venture capital firm get to keep $2 million, or 20% of that $10 million. So this is typical. Again, there's nothing, don't think that this is exactly how things go, but these are just some sort of average numbers, right? And the difference between, as you can see, between a ho-hum venture capital firm and a really great venture capital firm can be that that 10x return in one firm turns out to be a 0, and in another firm it turns out you get 2 10x returns, right? Which means I would have got $30 million back, a total of $30 million back for my $10 million that I invested. So this is sort of why understanding the stage of the company and the risk is really, really important, right? And the other part here that I want you to think about is oftentimes you hear about venture capitalists saying, and when they speak to entrepreneurs, the entrepreneur saying, "Oh my God, I can't believe how little they valued my company for." Well, the venture capitalist can do the calculation and say, if I invest $1 million in your company and I own 10% of your company, and so if I want to get 10 million back, that means we need to sell your company for $100 million at some point in the future, right? That means if at some point in the future I want to sell it for $100 million, I need to own 10% of it, which means that if it's valued at $1 million today, or excuse me, if I'm investing $1 million, then I can, where do I value your company at? It's got to be less than 10 million, right? So you do the arithmetic there. We'll get into that in a little more detail, but that's why understanding the stage and the risk is really important. So this is a very important concept. Please think about this concept, and because it will play a big role in your understanding, either as an entrepreneur or as someone going into the venture capital business or the private equity business, understanding sort of the various different investment theses and the parameters you need to make those investments at. Now that we've gone through that theoretical example, let's take a look at, given the risk, what returns does the investor need, right? Remember our first slide? 5 out of 10, 4 out of 10, 2 out of 10, 1 out of 10. So if you're a late stage investor, okay, in the late stages, the risk is lower and you're not going to get as large a return per investment. So in a late stage company, or late stage venture capital firm, only one of those companies is going to go out of business. So 9 of them will exist, right? So if you get back on $1 million investment, you get back $1.2 million or $2 million, let's say just double it, right? Not a 10x, but a 2x. You double it, you're getting $20 million back, or 18, if you do the arithmetic, I guess, because one of them's going out of business. But that's a pretty good ratio. So there, your parameters and your valuation and how you manage the investment is a lot different than someone who's in the seed stage, right? The seed stage expects a much bigger return, potential return for each investment, whereas in a late stage, they expect a lower investment in the lower stages. That's why when you read in the news that some high flyer company raised $50 million at $1 billion investment, right? That investor is hoping that that company gets sold for $3-4 billion, right? Because it's a mature company at that point in time, hopefully. They're not expecting that company to be sold for $100 billion. If that was a seed stage company at that time of investment, that's what they'd have to hope for in order to make a return. So again, this is a very important concept. It's fundamental to investing. It's fundamental to being an entrepreneur, and understanding this is really, really key. So if you have any questions, please use the forum to submit them to me, because that way your fellow students can read them, and your fellow students will get the benefit of your question as well as my response. Now what we're going to do is take a look at a very specific example, mostly fictitious, but not 100%. This was actually very similar to one of the companies that I started, and how it worked out. I drew some of the numbers from there. So here's the setup. You and your partner decide to start a company, and you own that company, and you decide to split the company 50-50 between the two of you. You're working in the garage, and let's just say it's a software company. So you're developing some programs for a particular application that solves some kind of problem for potential customers. And after a month or two, you start getting tired of eating cold beans out of a can because you have no money, and you realize you have to buy some equipment. You may need to hire a person or two. You need to have an accountant to keep track of your expenses, etc. So you ponder sort of raising some capital, and you figure out that you need about $100,000, and you go to friends and family. So you go to your parents, you go to your Uncle George, and you go to Grandpa Ralph. Okay, and what you're trying to do is raise $100,000. And somehow, as you're talking to these angel investors, or friends and family, I should call them, excuse me, friends and family, they're very kind to you, and you decide that your company's worth $500,000 based upon your great education, your work experience, and sort of the progress you've made to date in developing your very prototype product. So what we want to try to figure out is what percentage of the company does $100,000 buy. So you've decided that the company has a pre-money valuation. So there's some important concepts we're going to cover here. Pre-money valuation, okay, of $500,000. And your investors in total are going to invest $100,000. So how do we figure that out? Well, the way you do it is you take the total amount of money invested, which in this case is $100,000, and you divide it by the pre-money value plus the money that was raised. So in this case, that would be $500,000 plus $100,000, or a total of $600,000. So if you take $100,000 divided by $600,000, you end up buying 16% of the company, or your investors will own 16% of the company. Because remember, what we're doing is we're raising equity here. It's not a loan. They're actually buying shares of stock in your company. Now, you may say to yourself, well, wait a minute, that doesn't make sense. My company's worth $500,000. They're giving me 100. So why wouldn't it buy 20% of the company, right? So that's one way of thinking about it, but let me try to explain why it's actually 16%. Because the 2 seconds before people make that investment, your company is worth $500,000. 1 second after that $100,000 goes into your bank, your company now is worth $600,000. And they have actually purchased part of that company. They're buying the company after the investment, immediately after the investment, not immediately before. And this is a standard in the industry. So that's sort of how it works, but I just wanted to take you through that little subtlety about how, well, jeepers, that doesn't make sense. Why wouldn't the 100,000 be divided by 500,000? So again, people are going to invest $100,000. You've determined that your company is worth 500,000. In subsequent lectures, we will get into valuation and how to think about valuation of a company. But for this example, let's just assume we've established it at 500,000. That's known, again, as the pre-money valuation of your company. And then to calculate what percentage of the company the $100,000 buys, it's 100,000 divided by 600,000, or 16%. And what happened here is that your parents in total put in $25,000. Uncle George put in $25,000. And Grandpa, Ralph, put in $50,000. So you can calculate their percentage ownership the same way. You can take 50,000 divided by 600,000 and you'll get 8.3%. Okay? So the post-money valuation, which is another important concept in the venture capital world, is $600,000, right? Because that's the value of the company post the investment or after the investment. So there's some important concepts here. Make sure you understand them. Make sure you understand how the arithmetic happens and works. If you have any questions, please post the questions to the forum and we'll answer them for everyone's benefit. But pay good, close attention to this slide and the things we've spoken about because these examples is the foundation. This slide is the foundation for the subsequent slides and the way the whole valuation and stock ownership, etc. works. Okay? Okay, so let's continue. You just received that $100,000 investment from your friends and family. You've taken that money, you've invested it in the company. You've made some great progress. Let's say you have a working prototype now. And you go out and talk to some venture capitalists to see if you can convince them of making an investment in your company. And your business plan shows that for the next period of time, you're going to need about $500,000. You need to hire some more programmers, some more engineers. And through some negotiations, you find a venture capitalist who's interested in your business. And through some negotiations with them, you come up with a $3 million pre-money valuation. Again, in subsequent lectures, we're going to talk about how people determine pre-money valuations. But for now, let's just agree that they're going to invest $500,000 at a $3 million pre-money valuation. So the VC says yes, you sign the papers, everyone's happy, that $500,000 hits your bank account. So let's take a look at what the ownership of the company would look like at this point in time. So remember, on day one, you and your partner own 50% of the company each. You decided that's how you're going to divide up the ownership. Then we had friends and family invest. They invested $100,000 at a $500,000 pre-money valuation, right? And we made the calculation that bought 16%. Approximately, there's some rounding here going on, so that's why the numbers don't totally add up for you guys with calculating minds. but it's close enough for us here. And so Uncle George, remember, Uncle George invested $25,000. He owned 4.2%. Grandpa owns 8.3%. Mom and Dad collectively own 4.2%. And you and your partner went down from 50% ownership, right, to owning 41.7% each. Why is that? Well, this has to add up to 100%, right? So the ownership of the company always adds up to 100%. So again, approximate, we get the numbers. Then you found this venture capitalist who agreed to invest $500,000, right, at a $3 million pre. And here you can, again, do the arithmetic. If you took, let me see, so how did we calculate this 14.3%, right? What we did is we took 500,000 and we divided it by 3 million plus the amount of the investment. So that would be 3,500 there, right? And I think if you do that arithmetic, you'll find out it comes out to approximately 14.3%. That's what the VC owns of the company. Okay, so pretty simple arithmetic, and you can make the similar calculations for yourself and Uncle Ralph or Grandpa Ralph, Uncle George, and your mom and dad. So again, important that you understand this. If there's any confusion, please email me. But again, this is a very important concept, and it's key both for the VC and for the investor, and you, the entrepreneur. And remember, drawing on some of our previous lectures, we're going to see how this 14.3% that the VC purchased plays a big role in their outcome in this investment. So you take that $500,000 that the first VC invested, you and your partner and your team, you work your butts off, you spend all the money, you make good progress, you introduce your product to the marketplace, and you start looking for more money because typical small company burns more money than it generates in selling products. It needs some investment to build out its manufacturing facilities, hire more people, build out a marketing and sales organization, etc. So you're looking to raise $3 million now. So this would be round 2. This is sometimes would be called Series B. So oftentimes the first investment made by a venture capitalist is called Series A, just meaning they actually label the stock that way. It's not important, but oftentimes you'll hear people talking about, I'm looking for a Series A round, or I'm looking for a seed round. Those are often synonymous with each other. I think that's a word. This now would be Series B. Okay, so you're looking to raise $3 million and at an $8 million pre-money valuation, right? So hopefully, as you raise money, you see here that each time you raise it, hopefully the valuation is going up, right? That means you're making good progress typically, and investors like your company, or potential investors like your company. So you find a venture capitalist who says yes to this deal of $3 million, right, at an $8 million pre. So you raise that round, you sign the papers, the $3 million hits your bank account, and away you go. Everything's good. So now let's take a look, right? So we have this, we could typically call this first round of $100,000. This would be typically called an angel round. This would be called the 500,000 would be Series A, typically, often, or a seed round. And this would be called Series B. So again, you raise $3 million at an $8 million pre, right? That buys 27% of the company. So how did we calculate that? We took the 3 million and we divided it by 8 plus the amount of money invested, 3. So 3 divided into 11. That gives you approximately 27%. And then you can calculate the ownerships of the other investors. So you can see that each time you raise money, ownership percentage of the previous rounds of investors goes down, right? The only way that it doesn't go down is if the previous investor would invest again at the B round, and they would invest what's called their pro rata share. So pro rata share would be the amount of money that this VC, VC1 as I have it labeled, would have to invest to maintain 14.3%. And we can figure that out. It's pretty simple arithmetic. Not going to go there. It's not that important, but the concept is important, right? Again, this always has to add up to 100%. So if this VC is buying 27.3%, that 27.3% needs to come out of the ownership of all of these other investors. Okay, so and again, the way to prevent that, and sometimes VCs will have that right. They will have a right that says, I can, at my discretion, if I want to, invest more money at follow-on rounds to maintain my ownership. Okay, so pretty important. So let's talk about this for a second. Let's say that you're a good CEO and you write a nice letter to all your existing shareholders saying, hey, look, thank you for investing, Grandpa. We now raised more money, and our company is now worth, how much is our post-money valuation here? Our post-money would be the $3 million plus the 8 or $11 million. And you say to Grandpa, hey, my company's worth $11 million bucks, Grandpa. Thank you very much for having faith in me 2 years ago when we started this company. And Grandpa says, oh, well, that's good for you, but I used to own 8.3%, but now I only own 5.2%. What's going on, Sonny? Why am I owning less of the company? And what would you explain to Grandpa? Well, what you would explain to him is, Grandpa, here, when you made the investment, you owned 8.3% of a company worth $600,000. Now you own 5.2% of a company worth $11 million. So that should make Grandpa happy. The challenge here is if Grandpa says, okay, Sonny, send me the money. And then you have to explain to Grandpa that this is a private equity, and those shares of stock are not liquid. And you have to invest those, hopefully, or you can cash those out, Grandpa, at some point in the future. But right now, this is a privately held company. And the good news is you own 5.2% of an $11 million company, but it's not a liquid investment right now, right? So that's another term. Liquid means you can take that share of stock and convert it into cash. This is not that way because these are private shares of stock. It's a privately held company, and you can't go and sell those shares of stock to somebody else just willy-nilly. Okay, so let's keep going. As with most companies, you churn through a lot of capital. It's very expensive to start a business and grow manufacturing and product development, develop next generations of product. So by this point in time, you probably have some pretty good sales, your products out there, and you're really trying to expand your market and maybe generate or develop additional products to generate some additional revenue. So now you're looking to raise $7 million, right? At a $13 million pre-money valuation. You find a willing investor who says yes to the deal, and you close on that investment. So let's take a look at how the ownership looks after this round. So what would we call this round of investment? Let's see. This one we called A, Series A. This one we called Series B. And this one we would call Series C. Pretty simple. So here again, it was a $7 million raise at a $13 million pre-money valuation. So the post-money would be $20 million. Okay, and you can do the calculations all along the way here as to who owns what. And again, you can see that this latest investor now owns 35% of the company, and everyone else's shares went down, and their ownership went down. You and your partner now only own barely just under 17% of the company, where in day one you own 50% of it. But again, now you're owning 17% of a company valued at $20 million, and not valued at, well, the day you started, zero for the most part. So pretty simple. Hope you can understand how the arithmetic works here, but it's an important concept. Describing the ownership of the company in this manner, meaning a table like this with who owns what, is often called a cap table or a company capitalization table. So cap table is short for capitalization. So that's what this is often called, and it sort of defines who owns, which individuals or institutions own what amount of money or what amount of shares of stock, what the percentage ownership of shares of stock are within the company. So again, cap table, important concept. So let's keep going. Things are humming along. Things are going good. You're now generating enough revenue that you don't need to raise any more money. The company's doing well. You're bringing more money in than you're spending. People are being paid well. Everybody's happy. Except the investors are going, hey, wait a minute, I'm not making any money. I just own shares of stock. Let's see if we can sell this company to somebody. And lo and behold, Microsoft comes along and wants to buy your company. And they offer $45 million for your company. Right? And you get the board of directors together. The board of directors approves that acquisition by Microsoft. So my question to you is, well, what percentage of the company is Microsoft buying for $45 million? Well, they are buying 100% of the company for $45 million. Right? So what's the pre-money valuation? $45 million. The post-money is $45 million. Okay? Because you are selling 100% of the company to Microsoft. So that's all great. Everyone looks pretty happy. The deal closes, and $45 million goes into the company bank account. So let's take a look at the returns this generated for the various different investors and for the founders and entrepreneurs. So remember, 45 million buys 100% of the company. So you and your partner owned 16.9% of the company. So you take 16.9% of the 45 million and you get almost $7.6 million. Your partner, your co-founder, same thing. Okay, so let's take a look at Uncle George. If we remember correctly, Uncle George invested $25,000. Here at the end, he only owned 1.7% of the company. But 1.7% of that 45 million is $759,000. So he invested $25,000. He got out $759,000. Right? So that's quite a very, very nice return. If I try to do the calculation on that, I think that comes out to be an approximately 30x return. In other words, he made 30 times his money. And again, let's go to Grandpa Ralph. Remember, he invested $50,000, right? And he turned that $50,000 into $1.5 million. And again, here the percentage for these people are all the same, so it's 30%, and the same thing for your mom and dad. So your friends and family now are all very happy because they all made 30 times their money. let's take a look at VC1, okay, the first venture capitalist. The first venture capitalist invested $500,000, right? At the end, they owned 6.8%, and their return was $3 million. So they made approximately 6 times, oh, if I can draw a 6 here, they made approximately 6 times their investment. So not bad. Not bad at all, right? Now, the second VC invested $3 million. They owned at the end 17.7%. So $3 million, they made slightly over 2 times their investment, right? So 2 plus times their investment. So again, not bad. And the final investor, who invested $7 million, owned 35% at the end, and $7 million, they made a little bit 2 plus times their investment as well. Okay, so let's take a look at this. What does this mean? So why did these people make 30 times their investment and these people make 2? Well, remember, the risk was the highest in the beginning, right? So when you and your partner quit your jobs and left your lucrative jobs at Google to start this business, you guys took a big risk, right? So you made the most money. Uncle George, Grandpa Ralph, your mom and dad took a huge risk when they invested that $100,000 collectively. You had nothing other than your good character, your education, and some work experience, right? So they made the greatest amount of money on a percentage basis, right? That's why they made 30 times their money. The first VC also took a pretty big risk, but a smaller risk than your mom and dad and your friends and family, right? So they made a slightly less, or significantly less in this case, multiple on their investment return. The second VC, again, the company was more mature, it was less risky, you had established manufacturing, production, you had a product out there, so their risk was a little bit lower. And so they made somewhere between 2 and 3%, or 2 and 3 times, excuse me, return on their investments. Still very nice. And the final VC, right, you had an established company, you were almost running at break even. All you needed to do was hit the accelerator, build out some distribution and sales. They made just a slightly over $2 million. So this is what risk-adjusted return really is, right? And this is managing your returns and your risk. So you can see early stage investors, seed stage investors, they're taking a huge risk, right? And remember, in our first example that we talked about earlier in this lecture, we had that table. 5 of these are going to go out of business, right? So for this first VC here, right, he makes 10 investments, 5 are going out of business. He made a 6x on this one. So he needs a few more of those 6x's or higher in order to make some money and generate return. The sort of growth stage investor, lower risk, right? Fewer of once you invest at this point in time, right? Fewer of these companies are going to go out of business. So chances are that you don't need to generate a larger return because you can have fewer zeros, right? And this investor here, who came in very late in the game when the company was very mature, doing quite well, his risk was even lower, so he makes a smaller multiple. So this is how this scenario rolls out. Again, it's a very important concept, both for private equity firms and for venture capitalists and for company founders or company CEOs. And this type of modeling is very important, and it cuts across whether you're a VC investor or an LBO firm or you're a hedge fund investor, right? You're trying to do these types of things in any of those scenarios. So again, if you have any questions, please reach out to me. Preferred route is through the forum, so your fellow classmates can see those questions and they can see the response I provide to those questions. So a pretty good outcome for you and your partner. The two of you each get about $7.5 million, and all the investors in aggregate get about 20 million, or excuse me, 30 million. So everyone's happy, you all have a big party, and you go on to your next company that you want to start. So sort of a great success for everyone. Okay, so let's wrap up here. We covered some important concepts, right? Fundamentally, what I wanted you to get from this is this understanding of risk, and how risk is different at different stages in the company, and how different investors have to evaluate that risk when they think about valuing companies. Because remember, the investor's return is directly related to how, in essence, what they pay for each share of stock. Right? That part is just like the public markets. Right? If you're paying $1 for each share and you only sell it for $1.25, you didn't make much money. But if you sell it for $1, excuse me, if you buy it for $1 and then can sell it for 10, you made a lot of money. So if you're buying shares for $1 and you know some of those are going to go to 0, you have to be able to get some that go to $10. So some very important concepts in this lecture. I hope they were clear. And again, if they weren't, please use the forum. And again, if some of those questions still remain, we will have an opportunity in the classroom to discuss these in more detail if need be. Thank you very much.